Hey guys, Kenny Starks here, your local real estate agent, and I'm here with my December real estate market update. This is information just here to educate you and inform you of what's going on in the real estate market so you can make a conscious decision and educated decision when it comes to buy, selling, and investing. So we're going to dive into a lot. We're going to go over unemployment. We're going to go over consumer spending. We're going to go over a lot of information because I know I get a lot of questions of what's going on in the market today, or what's changing and what's new. And there's certainly a lot of uncertainty in the world today. So I do these videos just to bring a little bit of certainty to the buyers and sellers in today's economy. So I'm going to dive into it. I'm going to package it up into a way that you can understand it, and you can easily share this video if you like it. Subscribe and pay attention to further videos that's coming. So let's dive right into it. I'm going to start this monthly market report off with looking at what the GDP growth is. Our experts forecast it and what experts are what actually happened. Back in April 1st, the big financial institutions, when the crisis happened, they called for a rapid V recovery, and what that means is just the economy goes down and it goes up over time. It looks like a V. If we look at this chart here, back in the first quarter, we were doing good, and then when it comes to the second quarter, we hit this downturn right here, and they predicted that it was going to do a V recovery, and in the third quarter, we were going to bounce back. And if we look at actually what happened, this is what happened. In the first quarter, we did good for the first quarter. We took a slump in the second quarter. In the third quarter, we bounced back up to pretty much where we are today. And that's pretty much what happened. And what happened is the experts were right. They predicted a rapid V-shaped recovery with the real estate market. Not to say the same thing with the overall economy, but with the real estate market, we did experience that V-shaped recovery. We did talk about this last week in this market report, but I just wanted to touch bases with that. Okay, so next, let's go to the Wall Street Journal. Economist correspondent there said this. He says, news stories often describe the coronavirus-induced global economic downturn as the worst since the Great Depression. Yet for many, the comparison does more to terrify than to clarify. And pretty much what he's saying is that there's a lot of news going on in the world today that the pandemic is a lot worse than what it is. And of course it is a horrible thing that happened, and it's a pandemic, and it's, a lot of people died. Unfortunately, it affected a lot of people, but the headlines are really talking a lot about the negative effects of what is happening. They're not really talking about the good things. So I'm going to try to clarify up a couple of good things that's happening in our economy right now, and also give you the facts of what the experts are saying. So let's go to the next slide here. This next slide is going to go over what the average U.S. FICO score has happened over the last year or so. So if you look at this chart here, on the left here, you see it starts in April 2019, and it goes all the way up to July of this year, 2020. This is according to the Wall Street Journal. This isn't like for big wig shots or anything like that. This is normal people, the normal consumer, the normal people that's out there buying goods. And this aren't people that's applying for home loans. Let me just put that out there. These are average normal people. So if you look from April 2019 to July 2020, the average credit score has risen about 6-7 points overall. This is overall. So this is a good thing. And we're going to discuss why that is happening here soon. Okay, let's go to this slide right here on the New York Fed and what they said about the people that received the stimulus check and what they did with the proceeds. So with this graph here, it shows the overall people that received the stimulus check. 36% of the people saved the money. So they put it in a bank account, they saved it for a rainy day, or they just didn't spend it. They put it up. 35% paid down debt. That means that they paid down any bills that they may have had. I'm not sure if that includes rent, but I don't think that includes rent. I'm pretty sure that just includes any past debt that they may have just wanted to get out of the way. 29% may have spent the money, and I'm believing that that's the part of the people that may have spent their money on the rent, or they probably spent the money, towards rent or any back due rent or anything like that. So 29% spent the money. They could have went on a spending spree or whatever. That's what the money was kind of for. They wanted to put that money back into the system. And, you can see that over 60% of it either paid down some debt or they saved the money. So that's just one thing that's not being talked about. So I'm not going to drag on too long there, but that's a good thing that's happening in the economy, and we can continue to, promote the good that's happening. So let's go on to another good thing. In business applications across the United States, they skyrocketed. So as you can see, in this graph here, that business applications, people applying for new businesses, skyrocketed in 2020. I mean, it was off the charts. There was so many new businesses that came and put in an application. Either it was because they started a new business, or maybe it was something to do with the stimulus. Some people may have needed to start the official business to get the proceeds. But at the same time, it's really great because we can see that it's a huge jump in innovation. A lot of people may have seen a huge need during this crisis and say, hey, I want to start a business, or I'm going to change my business or alter my business to help people in need. So, that can be one of the good things that we can talk about. And it's not to say that, there's not any businesses that were affected by this, because there were tons of businesses, as we can see on the news every day. But it's just to show that even at times like this, that people can come together and be innovative and come up with new businesses and new ideas that can help us push through this. Like the great financial crisis of 2008, there was a lot of great businesses that came out of that are in business today that are pretty much leading the way for the next wave of innovation. So that's something that I just wanted to promote, and kudos to the Americans that's out there grinding and coming through, pushing through, innovating their businesses and getting a leg up on this pandemic. So that's not being talked about. Okay, and if we look at this graph here and changing consumer spending since January 1st, 2020, we can see that overall here, the United States we're about 3.7% less than what we were at the beginning of the year in regards to consumer spending. All of the orange places here are down or close to 0%. They're down 10% or close to 0%. Anything in the blue here is 0% or up to 10%. So all the blue ones are pretty much doing as well or better. The orange ones are doing as well or a little bit less as good. And then the red ones are not doing as good as the rest of the country or as before the pandemic happened. And the blue one here, a couple of outliers, they're really doing good, or they're doing even better than before the pandemic. So if you can see overall, when it comes to consumer spending, we're not doing that bad. It could be doing better, of course, but 3.7% compared to the first of the month, I mean, that's doing good. I think that's doing pretty well, but we definitely want to see that number continue to go back up as people get their jobs back and people are continuing to provide for the family and spend money in the economy, and businesses are reopened, and that's something that we want to see. But this is something that we're definitely going to keep our eye on, and I will keep you guys updated with that in the coming months. And so hopefully the stimulus package will come in as well and help that number go back up too as well. I mean, when the stimulus package does come in, and they've been talking a lot about it, it will help people put money back into the economy, which will help the consumer spending go back up, which will boost the economy. Okay, so let's look at the weekly unemployment filings compared to the millions according to the Bureau of Labor Statistics. And we look at the peak here at 6.9 million filings in 1 week back in, March 28th, at the end of March. And into April here, we have the peaks at pretty much 7 million a week. And that number continued to go down as where we are here at the end of October at about 750,000 filings per week. So that number has drastically went down, which is a good thing. But we definitely don't think that 750,000 a week is, a good number, but that isn't as bad as 7 million. And according to the Department of Labor, the people that are currently receiving unemployment insurance is decreasing drastically too. So as of March, you can see that the current number of people that were receiving unemployment was 3.1 million. And at the height of the pandemic, here in May, we had 24.9 people actually receiving unemployment. And as the time moved on, back at the end of October, we were down about 7.3 million people receiving unemployment. And that was a decrease from 538,000 from the week before. So that's a good thing. We want to continue to see that number decrease and people get back to their employment and get back to work. And, things are changing. He locked down the government once again, but, hopefully that doesn't hurt too many people and we can get back to work. Let's look at this quote from the Fed. They say that the data from the Survey of Business Uncertainty, the SBU, suggested that the road forward is going to be a tough slog. Businesses held tepid expectations for year ahead in employment and sales growth. Expectations are, in fact, so tepid that, based on the latest average projection, it will take firms more than 4.5 years to recover from their pre-COVID employment levels. And also what they're saying is that we're not out of the woods yet. We still got a lot of work to do before we recover and we get back to pre-COVID numbers. Let's look at some data on forbearances. The number of mortgages in active forbearance decreased drastically back in May compared to now. Back in May, there was about 4.7 million people in active forbearance. And at the end of October here, we got about 3 million in active forbearance. So that number is decreasing. The percentage of overall forbearances is decreasing. Here in October, it's down to about 5.8% of mortgages here in forbearance. You can see even across different classes of loans, they are decreasing all across the board. So we got 5.7 million people. We got 5,760,000 people that applied for forbearance and they were granted forbearance. And this is what happened upon the expiration dates. 397 people extended it. They may have needed more time to pay, or they maybe were still going through a financial hardship. So we're gonna look at the blue and the green graphs here. 2.3 million people actually removed while performing, and 500,000 people actually paid off their mortgage. The 500,000 people may have been people that may have, I want to say refinanced, but they may have sold their home, or they may have got rid of the home and got out of their mortgage. But the other 2.3 million, they were removed. So they either said that they didn't need it anymore, or they just got off of it and they just continued to pay their rent as normal. And so if we look at the 481,000 people that expired or delinquent in loss mitigation. These people are in loss mitigation. They're probably working something out with the bank and they're still trying to work to do it, and the bank's still not giving up on them. They're trying to work things out with them. If we look here on the far right, we see that 80,000 people either expired or they're delinquent. That means that they couldn't make the payment and they're just pretty much delinquent. So this small number, the 80,000, these are a number of people that may go to foreclosure. There's your answers right there. Out of 5.7 million people, only 80,000 of those people are delinquent or not able to pay their mortgages. The financial catastrophes that were in place in 2008 are not the same in today's pandemic. And one of the big differences between the economy then and the economy now is that the sellers and the property owners have more decisions. They have more equity in their home and they have more value. So that means that they can take the equity, they can sell their home, they can pay a commission, they can put some money up, they can downsize. It's just different options that they have now that the consumer didn't have back in 2008. Okay, so let's look at this quote from Ivy Zelman. She's a real estate investment and analytic firm. She has over 8,000 reports. I always love looking at her reports. It's great information. She reviews a lot of factors. And what she says that the likelihood of us having a foreclosure crisis again is about 0%. She looks at a lot of things. And like I said, she does about 8,000 reports, multifamily, single family. And she says it's about 0%. And we can go over some things why this is true. Okay, so let's look at this graph right here. It just shows us the months of inventory of homes for sale in the last 12 months. And these numbers that you see here on the graphs are months, are in months. So if we look at back in October last year, we were at 3.9 months of inventory. And at the end of September, we are at 2.7 months of inventory. And that's here 2020. And what that means is that if home kept selling at the rate that they are, we would be out of homes for sale in the entire nation in 2.7 months. Here locally, our numbers are even worse. Our numbers here are about 1.5 months. So that means that if we kept going at the current rate that we are now, we will be out of homes for sale in the entire market in a little over a month and a half. So that's our main concern right now, is we need more inventory. Let's look at some year-over-year change in listing statistics. The green line is new listings coming to the market, and the yellow line is total listings overall. And you can see here that as listings are coming to the market, and you can see here in early March, we took a really big dip. So people were holding off on putting their homes in the market, and it kind of caught up with the new listings. But then we slowly trickled in with new listings, and some came in a little bit faster. But as new listings came to the market, you can see that they were getting gobbled up just as fast as they were coming to the market. So our total listings are continuing to go down, and that's our inventory. Even as new listings are coming to the market, buyers are eating them up because it's just a great time to buy with rates being so low. So that's our major hurdle right now in the real estate industry, is inventory, compared to 2008 when there was an abundance of inventory and you couldn't find buyers for these homes anywhere. Now we have an influx of buyers, and they're gobbling up things left and right. They're buying up properties just as fast, or if not faster, than we can put them on the market. If we look at this Zillow report on the top 3 reasons why homeowners are not putting their homes on the market, we can see that the highest percent is that they think that it's just too uncertain right now. Certainly, there is a lot of uncertainty going on in the world right now, and 31% says financially they're uncertain of what's going to happen here in the next future, and 25% says, well, strictly it's just because COVID. I'm not going to list my house because I don't want people walking through my home. I don't want risk of catching COVID. You know, it's just a big concern for a lot of people out there right now, which is legit. You know, some people just are high risk, so they will rather wait and wait it out until see what's going to happen on the other end of everything. So waiting to sell your home, I get it. I mean, it's a legit concern that people want to wait the market out and see what's going to happen after the COVID thing right now. So waiting to put your house on the market can also affect your buying power. So if rates were going to rise, even though even though values are still rising and you still may get a good price for it, but on the buying side, if interest rise, then it may cost you more in the future when you're thinking about your monthly mortgage payment or how much you're going to pay for the next home. So I'm going to go to this quote from Jeff Tucker. He's an economist at Zillow. He says, homeowners who feel like life is uncertain right now may think that they can still get a strong price if they delay selling until they have more clarity. The catch is that waiting to sell may raise the cost of a trade-up. This fall's record low mortgage rates, which make a trade-up more affordable on a monthly basis, are not guaranteed to last. So what that means is that, even though homes are projected to, gain value here in the coming years, interest rates are going to raise as well. I mean, that's one thing that we do know for certain. The Feds aren't going to keep rates low forever. So if we look at this projection of home price appreciations, we see here on the far right, the core logic is still the underlier with 0.2% of price appreciation over the next year. But if you can see through the majority of them, we're looking at about 3.5 to 5.5% of price appreciation this year, or next year, I mean. So let's look at mortgage rates and the predictions for mortgage rates. NBA forecast to 2021 that, we may see some significant mortgage rate increase, and for the years to come, it may not be as huge as, a 1 or 2 or 3% increase, but it will increase for the years to come, as you can see here. So let's check out this housing affordability index from 1990 until today. If you look at this graph, in 2012, it was the peak of the affordability, and that's when the years where distressed markets really dominated the market. Investors were going in and buying them low and putting them back on the market, nice and spiffy for people to purchase, and they were pretty affordable back then. And if you look at today, we are kind of moving out of that area. We're kind of moving into where homes are getting a little bit more expensive now, and they're not as affordable as they used to be. I mean, so with that said, even though housing prices are rising, job wages aren't aren't rising as much as home values are rising. So what that's doing is slowly eating away at the affordability, even though it's a good thing for sellers and and the buyers that can afford them. But we're slowly but surely moving out of that affordability range where homes are not going to be as affordable as they were back in 2012. So that just shows the overall look at housing affordability, where we are and where we're going. Let's look at this quote from Mark Fleming. He says, "The good news is that affordability remains significantly higher than a year ago, mostly due to falling rates. One month does not make a trend, but this month's decline in affordability signals that the current dynamics producing faster house pricing appreciation may begin to erode the affordability gains of recent years." And that pretty much just goes to say that house appreciation could be a good thing, but not if nobody can afford the homes. And that's one thing that the nation is facing when it comes to, housing. Not only is it an inventory thing, but it's an affordability thing. I mean, jobs aren't increasing their wages enough. I mean, look what we're doing to get minimum wage increases. It's been taking dang near forever, and it's going to be $15 an hour. And even with the $15 an hour increase, with the prices of housing increasing so fast, what are people going to do with their options now? And, even though now is a pretty good time to buy with interest rates being so low, making it a little bit more affordable, it's just now the economy is so unpredictable that it kind of threw the buyers through a loop, but it is also putting a turtleneck on demand of the buyers that could have bought. They're going to hold out. For the years to come, these buyers may still be flooding the market. So guys, thanks for watching. This was my monthly market report. Hopefully this video has helped you out in any way. And I realize you may or may not be looking to buy, sell, or invest into real estate. But if this video has helped you out and you have any more questions, please pass along my information or give me a call. I would love to help you out. Thanks for watching.